And that in a nutshell is OPEB. That's what the old pension standards used to be, what will cease to be in a few years when governments implement the new standards for OPEB. So let's move on then to talk about pensions under GASB Statement 68, which was issued in June of 2012 and which governments are in the process of implementing now. It applies strictly to pensions that are provided through a trust that meets 3 criteria: that the contributions of the employer and of other entities are irrevocable or irrevocable, however you'd like to pronounce it, meaning once they're in, they can't come out. The assets in the plan are dedicated to providing pensions, and those assets are legally protected from creditors. It excludes all OPEB. It also excludes pensions that are provided through trusts that don't meet these criteria. Actually, when GASB proposed new standards for OPEB last year, it also proposed standards that would apply to those pensions that aren't covered by Statement 68. And so the OPEB standards actually will apply, that has provisions both for OPEB provided through these kinds of trusts and, as is mostly the case for OPEB that isn't provided through a trust like that, or mostly isn't provided through a trust at all. These standards also clearly apply to entities, governmental entities, that make contributions to pension plans on behalf of other governments' employees, which is very common, for instance, for some state governments. The state of Michigan, for instance, is responsible for the pension benefits of all teachers in local school districts in Michigan. And so the state of Michigan is making contributions to the state, to the teacher pension plans, and therefore, rather than the school districts, the state government should be reporting the liability associated with those teacher pension benefits. Again, this covers, as the old standards do, covers defined contribution pensions as well, but those are a lot more straightforward because you're only interested in how much the government's required to contribute. There is no greater liability than that. The big deal really is the defined benefit pensions. The government's obligation or liability under the old standards was the UAAL, the unfunded actuarial liability. Under the new pension standards, it will be called a net pension liability, which is the difference between the total pension liability, which is kind of analogous to the AAL, minus the pension plan's fiduciary net position. So instead of the AVA, which is a smooth value, the pension plan's fiduciary net position is the market value as of the date of the financial state, or as of the date that you measured the liability. So the TPL minus the plan's fiduciary net position equals the NPL, or net pension liability, and that amount will be recognized on the face of the financial statements rather than just disclosed. So a single employer or a government and an agent multiple employer plan, their 100% of their NPL is going to be recognized on the face of the financial statements. For cost-sharing employers, because the valuation and the measurement is done for the plan as a whole, they will need to calculate what their proportionate share is of that collective net pension liability, and they'll report that proportion, that share of the cumulative net pension liability as their own on their own financial statements. The measurement of the net pension liability is going to be done either as of the date of the financial statements or sometime during the year preceding. Most often it's going to be sometime during the year preceding, because it takes time to do this, and if the government waited until the last day of the fiscal year, it would affect the timeliness of the financial reporting. So as long as it's done within a year prior to the end of the fiscal year, that's okay. Both the total pension liability and the net position of the plan are going to be measured at the same time. So that will probably mean for a lot of governments it's going to be the end of the prior fiscal year, so that because you know that the plan net position is going to be measured on that date for the plan's financial reporting, whereas if you do it sometime in the middle of the year, it would take some cost and effort to measure the plan net position as of that date. The actuarial valuation that the measurement is based on is either going to take place on the measurement date or on a date no more than 30 months and a day prior to the end of the fiscal year that the government's reporting on. However, if it's not, if the actuarial valuation date is earlier than the measurement date, then the government will have to do some what are called roll forward or updating procedures to address anything that's changed between the actuarial valuation date and the measurement date. And that will make this information a lot fresher than it was under the old standards. So, for example, if a government has a June 30th, 2015 fiscal year end, its measurement date would have to be no earlier than June 30th, 2014, and the actuarial valuation date would have to be no earlier than December 31st, 2012. But if it were any earlier than June 30th, 2014, the government would take these roll forward or updating procedures in order to update the valuation to the measurement date of June 30th, 2014. And if the updating is is really very significant, very substantial, they may in fact need to do an entirely new valuation. Those same three broad measurement steps that we talked about for OPEB, those are still the same three broad measurement steps that will measure the net pension liability. The difference, though, is that those assumptions and methods that are allowed under the old standards for pensions and OPEB will be significantly limited under the new pension standards, and I'll point out where that is the case. The methods and the assumptions generally that are made should be in conformity with actuarial standards of practice, and that is an easier thing to say than to lay out very, very specific assumption parameters in the accounting standards. The actuarial standards of practice lay out what's an appropriate assumption and what's not, and that's their sphere of influence, and it's easier to refer to them and say you need to be consistent with what they say. The projection of future pension benefit payments is based upon the terms of the plan as of the measurement date. It's based upon the members of the plan, both the current active employees and the inactive retirees. It should incorporate assumptions about anything that is relevant to determining the amount of the payment, such as how long somebody works, the service credits, what their salary was, whether there are provisions for cost of living adjustments or COLAs. One thing that is different is, in addition to automatic benefit changes and automatic COLAs, which are written into the terms of the pension plan, the projections also ought to include ad hoc benefit changes or ad hoc COLAs if they are substantively automatic. Ad hoc COLAs, for instance, are not written into the terms of the plan. They require a decision on the part of the government, like the legislature will pass a law and say we're going to have a cost of living adjustment to pension benefits that will improve them by 2%. That's not written into the plan. That's something that the government does in addition. But if those are happening with a frequency, that they've come to be expected essentially, and everybody understands, even though they're not written in the plan, they're going to happen. You could call those substantively automatic, and they ought to be included in the projection of benefit payments, whereas under the old standards they were not. Discounting, in general, is still based upon the long-term expected rate of return, but with limits. That can continue to be used as the discount rate as long as the net position of the plan is expected to be sufficient to pay benefit payments. If it's not, if you reach a point where that is no longer true, and it's no longer true that the plan assets are going to be invested using a strategy that will achieve a long-term rate of return, then the discounting should be done using a municipal bond index rate specifically one that's for 20-year tax-exempt general obligation bonds that are rated AA or higher or their equivalent. So what a government is going to do is, in addition to projecting the benefit payments, they're going to project how much will be in the plan available to make those benefit payments. And in simplistic terms, looking at each projected benefit year, if the projected plan net position is greater than the projected benefit payments, they'll discount that year's projected benefit payments using the long-term expected rate of return. However, if they get to a point in those projections where the plan net position is projected to be less than the projected benefit payments, then in that year and every year going forward from there, they will discount using the municipal bond rate. And under current market conditions, the municipal bond rate is considerably less. Right now, a lot of long-term expected rate of returns are 7.25%, 7.5%. That municipal bond rate is probably around 4% or so right now. And as you know, the lower the discount rate, the larger the present value. And the larger the present value, therefore, the larger the liability that they're going to report in the financial statements. And this is, harkens back to my point earlier about the OPEB standards and how that average rate is going to be applied to every single year for discounting. In this case, they're discounting with either the long-term expected rate of return or the municipal bond rate. But you will hear a reference when people are talking about the discount rate under the new pension standards to something called the single discount rate, which some people will call an average rate. And it is, but that single discount rate is never used to discount any projected benefit payments. What it is a calculation of what one rate could have produced the same present value that was produced by using two different rates for different years in the future. That's something that a government has to calculate because it's a part of the disclosure requirements, and I'll mention those more in a little bit. But in every year, from a mechanical standpoint, they're either discounting using the long-term rate or the municipal bond rate. They're never discounting using that single average discount rate the same way they do for OPEB. Once you have the present value, you attribute to past periods and future periods. Unlike the old standards where they had a choice among 6 methods that could be applied as a level dollar amount or a level percentage of payroll, under the new pension standards, everybody will use entry age as the attribution method, and it will be done as a level percentage of pay. So you've essentially gone from 12 possibilities to 1. It should be noted that the vast majority of governments use entry age already, so it won't be a change for them. There may be a change depending upon whether they use level dollar or level percentage, but something like 2/3 to 3/4 of the governments are already using entry age. The basis for reporting pension expense is the change in the net pension liability from one year to the next. So the NPL that is recognized for this year minus last year's NPL is the change in the NPL for the year, and some portions of that will be reported as pension expense right away. Other portions will be reported initially as deferred inflows or deferred outflows of resources, and then introduced into pension expense over multiple years. Most items, like service cost, interest on the pension liability, the impact on the net pension liability of benefit changes. So if there's an improvement in the benefits that increases the net pension liability by $100 million, that $100 million will be reported as pension expense immediately. The impact on the net pension liability of projected earnings on pension plan investments, that gets introduced into pension expense immediately as well. Any other cause of changes in the net pension liability from year to year will be introduced into pension expense over multiple years. We're talking about 4 things here. The effect of differences between expected and actual experience with demographic and economic factors that affect the size of the liability, like inflation, assumptions about mortality, how long people are going to live, and so on. These are usually referred to as experience gains and losses. The effect of changes in the assumptions. So we used to assume people were going to live till 80, and now we're assuming they're going to live till 82 because they've been living longer. That would increase, all other things being equal, that would increase the size of the liability. The difference between what was projected for earnings on the pension plan's assets and what it actually earned, and then employer contributions that are made after the measurement date. So let's say that the net pension liability is measured as of the last day of the prior fiscal year, and then a contribution is made during the year. You're not going to go back and remeasure the liability. The liability is going to be reported as of the measurement date, and so something needs to be done with those contributions before you incorporate them into the reporting of the net pension liability. So starting with those first two, the changes in assumptions and the experience gains and losses, the portion of the change in the net pension liability that results from both of those will be reported as a deferred inflow or a deferred outflow, and then beginning in that period, you will introduce a portion of that deferred amount into pension expense, and you will do it over a period that is equal to the average remaining service lives of all of the employees in the plan, both active employees and retirees. That you can expect is going to be a much shorter period than the 30 years that amortization takes place now under the old standards. If you told me that this average period was 10 years, that wouldn't surprise me because the government employment base is relatively old and relatively close to retirement. Plus you have all these retirees in there who are already retired, so they have no remaining service life. So that's going to be a much shorter period over which those changes in the net pension liability make their way into pension expense. For the difference between projected and actual earnings on plan investments, those will be reported initially as a deferred inflow or outflow, and then beginning in that first period, introduced into pension expense over a closed 5-year period. The last item, employer contributions made since the measurement date, those will be made, excuse me, those will be reported in the year they're made as a deferred outflow of resources related to pensions, and then in the next period they will reduce the net pension liability. This is something that actually is a change in the net pension liability that is not reflected in pension expense. It's reflected directly in the reporting of the net pension liability. For cost-sharing employers, where this measurement that we've been talking about isn't done for each of them individually, but for their plan as a whole, they will be recognizing their proportionate share of the collective net pension liability, collective pension expense, and collective deferrals for the plan as a whole. Their proportion should be determined in a manner that's consistent with their contributions to the plan relative to the contributions of all of the entities that are contributing to the plan. They may need more than one rate if there are separate portions of the plan. For instance, within a cost-sharing plan, there may be separate sectors for general employees versus public safety employees, and the benefits they receive may be different. And one government may have a larger proportion of the general employee portion than they do of the public safety portion of the plan, or vice versa. So they may have more than one proportion that they're using. The standards encourage them to base this proportion on their long-term contribution efforts, so what they expect to be contributing over a long period of time. But it's not required. The board had proposed requiring that, and got a lot of feedback that might be difficult for some governments to do, and so a government could conceivably base this proportion just upon what their contributions were last year. Where that becomes a problem is that if you're just looking year to year, their proportion could change notably or noticeably from one year to the next. And if their proportion changes, that's going to affect what they're reporting as their net pension liability as well. And so for these cost-sharing governments, there are some additional things that could cause their net pension liability to change from year to year that they would need to deal with in the accounting. And I won't get into this in tremendous detail, but if there's a change in their proportion, like this year it was 15%, next year it's 16%, then their net pension liability is not only increasing because the net pension liability for the whole plan increased, but also because they now have a larger proportion of the cumulative liability for the plan as a whole. There might be a difference between what they assumed was their proportionate share and what it actually turned out to be. And then, again, if they've made contributions subsequent to the measurement date, those have to be dealt with as well. The effect of the first two items will be reported as a deferred inflow or outflow of resources, and beginning in that period, introduced into pension expense over the average remaining service lives of all members of the plan. And then the third item will be handled exactly the way it is for the other employers, which is it's a deferred outflow of resources when it's made, and in the following year it reduces the net pension liability. The standards also specifically address what are referred to as non-employer contributing entities, and this is someone other than the employer who makes contributions on behalf of the employees for their pension benefits. How those are dealt with under the accounting standards depends upon whether it's considered to be a special funding situation or not. A special funding situation is one in which the amount that is contributed by this non-employer contributing entity doesn't depend upon events that are unrelated to the pensions, or if the non-employer is the only entity with a legal obligation to contribute. So an event that's unrelated to the pensions might be the government's responsible for contributing an amount that's equal to 5% of income tax revenues for the year. That has nothing to do with the pensions. And that would not be considered a special funding situation. If this is a special funding situation, then the employer and the non-employer contributing entities are essentially going to split the liability much in the same way a cost-sharing government would. So they're going to look at what their proportionate shares are, and the employer is going to recognize its proportionate share of the pension liability, and the non-employer contributing entity in its own financial statements will report its proportionate share. And it will report that proportionate share separately from its reporting of the net pension liability for its own employees. If it's not considered to be a special funding situation, then the employer is going to recognize revenue equal to the change in its net pension liability that resulted from these contributions made by another entity, and the non-employer entity is going to treat the expense related to these contributions the same way they would for any other type of grant payment that they might make to a governmental employer. As with the existing standards, there's an extensive list of disclosures that employers are required to make. I didn't really get into any detail with the OPEB standards, but they're a lot of the same descriptive information that governments will make for pensions. They've been making for pensions all along. They make for OPEB as well. They describe the type of plan. Is it a single employer plan, a multiple employer agent plan? Is it defined benefit versus defined contribution? Who administers the plan? What are the types of benefits? What types of employees are covered? How are the contributions determined? If there is a report available for the plan itself, the note disclosure of the employee ought to indicate how to get it, hopefully with a link to the plan rather than just an address or a phone number. The significant assumptions and methods that are used to calculate the total pension liability are disclosed. The new pension standards are more robust in their disclosures related to the discount rate, meaning they used to really just disclose what the rate was, and under the new standards they're going to have to really explain how they arrived at that assumed discount rate. If they have a crossover point, a point where they have to start using the municipal bond rate to discount, then they're going to say what periods they discounted using the long-term rate and what periods they discounted using the municipal bond rate. They'll tell you what that municipal bond rate was and how they chose it. They will also disclose that single discount rate I mentioned, and then they will show what the impact is on the net pension liability if it had been discounted using a single discount rate 1 percentage point higher or 1 percentage point lower. So you'll see, how much the net pension liability would have been reduced if the discount rate had been 1 percentage point higher, and how much the net pension liability would increase if they had used a single discount rate that was 1 percentage point lower. All employers will provide information about the fiduciary net position of the pension plan, or refer to how you can see that information in the report of the plan. They'll tell you what the measurement date was, what the actuarial valuation date was, whether there have been changes in the assumptions, whether there have been changes in the benefit terms, whether any changes have taken place subsequent to the measurement date. So they wouldn't be reflected in the measurement, but those changes have taken place, and so they're going to have an effect on that measurement next year. Whatever the pension expense amount was, if it's not separately identifiable in the financial statements, and it typically is not, that amount will be disclosed. The deferred inflows and outflows that I was talking about before, related to changes in the net pension liability that get introduced gradually into pension expense, there will be a disclosure that shows the amounts of those deferrals by the source, for instance, the experience gains and losses or the changes in assumptions and so on. And then you will also see in that disclosure how much of those deferrals are going to make their way into pension expense in each of the next 5 years, and then in the aggregate for all years beyond year 5. For employers in single and agent plans, they will disclose the changes in the net pension liability for the year by those sources that we were talking about before. So you will see the dollar amount. If you know that the net pension liability changed as a whole by $100 million, you'll see the dollar amount that was because of benefit changes, because of service cost, because of interest, because of differences between projected and actual investment returns, and so on. Single and agent employers will also disclose the number of employees who were covered, breaking that out between active employees, inactives who are receiving benefits, and inactives who are not yet receiving benefits. Cost-sharing employers will disclose what their proportion is, how they came up with that proportion, any changes in the proportion from the prior period, and then their proportionate share, the dollar amount, of the collective net pension liability. In addition to those notes, all governments will present 10-year schedules in required supplementary information. For single and agent employers, that disclosure of the changes in the net pension liability by source, they'll actually show that for the past 10 years. Eventually, they won't have that information for more than just the first year when they implement, but gradually over 10 years they will build up a full 10-year schedule. That schedule or a separate schedule will show ratios similar to the schedule of funding progress that I talked about for the existing OPEB standards and what was done previously for pensions. So you'll see the total pension liability, pension plan fiduciary net position, the net pension liability, then a ratio of plan net position to the total pension liability, which is very similar to the funded ratio, covered employee payroll, and then the net pension liability as a percentage of the covered employee payroll. If a government's contributions to its plan are based upon an actuarially determined employer contribution, or if under any other circumstance it calculates an actuarially determined employer contribution, then it will present a schedule that compares that ADEC, actuarially determined employer contribution, with the contributions that were actually made. They'll show the difference between the two, and then they will show the actual contributions as a percentage of the covered employee payroll. That's very similar to the schedule of employee contributions that is presented by some governments now, but now all governments will present it. And if they don't have an ADEC, but rather they contribute based on a statutory or a contractual requirement, then they'll present the schedule with that statutory or contractual amount in the comparison rather than the ADEC. For a cost-sharing government, they're going to show 10-year schedules that include their proportionate share, so the dollar amount of the collective net pension liability, a ratio that is their NPL as a percent of their covered employee payroll, and you will see that for the full 10 years. You will also see a separate RSI schedule that will compare their statutory or contractual contribution requirements with the amounts that they actually contributed. For non-employer contributing entities, they will present note disclosures in RSI related to their obligation for other employers' pension liabilities. That if it's a substantial proportion that they're responsible for, I can't tell you what that proportion is, but it's the kind of thing you know it if you see it. For instance, I think I can fairly safely say that if they're responsible for 100% of this other employer's pension obligation, that's substantial. I can't tell you what amount at which that it's no longer considered substantial, but if it is substantial, then their disclosures in RSI would look similar to what a cost-sharing employer would present for their net pension liability. If it's a less than substantial proportion, then it's a much more minimal set of note disclosures in RSI. These new standards are effective for fiscal years that began last July 1. And any fiscal year starting after that. We've already started to see some governments implement early, including the City of New York, and I hope to share with you, some excerpts from their CAFR, so you can see what their information looks like. And so over the period of the next year or so, we're going to start seeing these new financial statements that have implemented the new pension standards coming out in droves. We'll see this new liability on the face of the financial statements where it wasn't before, and get to see what kind of impact it's going to have on the reported financial position of the governments.